Hey everyone, this is Andy Michael with Seven Springs Wealth Group. Today I want to share what we're seeing in markets, address some top of mind questions we're getting from clients, and share a few actionable ideas as we head into the second quarter. So with that, let's get started. A few takeaways from what we've seen over the last 3 months. First and foremost, how important it is to just be invested and stay invested over the long term. Over the last 3 months, we've seen very large equity moves up anywhere from 5 to 10% across market indices. What that means is how important it is to stay invested. We don't know when those types of moves are going to come in the market. Most market forecasters didn't even have those level of returns occurring this year, let alone in the first quarter. So again, we don't know when the growth in markets will occur. That's why we feel it's important to just be invested so when it does happen, you're actively participating in it. Over those last 3 months, though, what has actually happened? What we've seen over here is that largely stocks have become more expensive than they were 3 months ago. This next 12 months price to earnings has increased, for example, on the S&P 500 by 7.5%, meaning I pay 7.5% more today to earn an expected dollar of profit from the S&P 500 companies than I paid 3 months ago. So we are seeing markets get a little bit more expensive in equities. However, in fixed income, we've seen just the opposite. In bonds, we've seen yields go up, meaning for a dollar that you're investing in those fixed income, in those bond markets, you're actually getting back more yield now than you were 3 months ago. Turning our attention to a little bit of supply and demand within the markets. First, I want to look at equities. What we see over here on the left-hand side is that S&P 500 companies have repurchased or are expected to repurchase approximately about $1 trillion per year of their own shares, taking those shares out of the market and retiring them. What that means is there's then fewer shares available of those high-quality, profitable companies going forward. That's a very favorable technical dynamic that we're seeing taking place in the market right now, and that's very different than what we see on the right-hand side here within the Treasury market. Over the last 10 years, we've seen Treasuries double the amount of supply available in the Treasury market, again now compared to 10 years ago, and we're seeing that supply continue to increase, while over here on the equities, we're seeing the supply continue to decrease. So I do think those supply and demand factors are worth watching and ones that continue to be a little bit more favorable for the equity markets. Let's talk about inflation. I have this beach ball here sitting on top of the water. I want you to think of that beach ball as our inflation ball. If the Federal Reserve was to take its hands, if you will, and place that ball underwater, it can keep that ball underwater for as long as it's keeping that pressure on the ball. The pressure on that ball right now the Federal Reserve's using is high interest rates. However, if that pressure is released, if we take our hands off the ball, what happens? The ball immediately pops back to the surface. We think the same type of thing is a material risk with the Federal Reserve when they cut interest rates. If they cut interest rates, there is a risk that we could see inflation resurface to the top of the water there when that pressure of keeping inflation down that the Federal Reserve is using is released. So I wanted to use that illustration as an example of one of the risks that we see, which is resurfacing inflation. How is that different than what I mean by deflate the ball? What I mean there is there are some deflationary forces such as the retiring baby boomer generation. Incoming is Gen Z workers and migrant workers that command lower salaries that could help with some of the wage growth pressures that we've seen in the past few years. And certainly artificial intelligence, productivity gains, that could be a deflationary force, but some of those are still unknown, and so they're opportunities, but they're certainly not guarantees. So we do think there are some deflationary forces out there beyond just what the Federal Reserve's pressure is doing. Some of those could actually let some of the air out of the inflation ball to keep it from ballooning. Moving on. Are we in a bubble? One of our top of mind questions that we want to address. I have 2 points to illustrate why I think we are not currently in a bubble, but a couple of other points to share on that as well. First, We do have some very, very large companies such as Apple, Tesla, Adobe, Nike, United Health down greater than 10% this year, as some of those companies are struggling with some of their growth metrics that they've been seeing. And so the market is not rewarding all companies. They are rewarding companies where they're seeing better growth trajectories. Also, I have our class of 2020, 2021, Zoom, GameStop, AMC, Peloton. These stocks not only are down double digits this year, they're down 80 to 90% still from the highs that was more bubble-like that we saw in 2020, 2021. And you can see some of that here in the initial public offerings available in the U.S. market back in 2020, 2021. That really spiked. That was showing you that those companies thought it was a good time to sell shares into the market. We've not seen that same level of participation in the last 3 years, even this year, even though we're starting to hear a couple more of those coming. Still very suppressed relative to what we saw during 2020 and 2021. So there can be some pockets of bubbles out there, but that doesn't necessarily mean the broad market is in a bubble. And lastly here, you don't have to have a bubble in order to have a sell-off. Look no further than the COVID-19 pandemic. We were not in a bubble in the pre-pandemic. No one was talking about bubbles at that time. We had a global event that caused a 35% drawdown in global markets. And so I just want to make a point there that it doesn't take a bubble to have a sell-off in the market. So though we don't see material risk of bubbles today in the market, it doesn't mean that there still couldn't be a sell-off for other reasons. A couple of actionable ideas for the quarter. Sync your capital to your calendar. What I mean by that is let your short-term needs be short-term invested and let your long-term needs be long-term invested. It's a wonderful time to get 5% yield on cash and cash-like investments. If you have short-term needs, let's raise that and keep it in cash. Have it ready to go and earn wonderful yields on it while we wait. Conversely, if you have long-term retirement needs, you need to beat the enemy of inflation. We just talked about it, still see it as a risk. Equities continue to be one of the best hedges long-term against inflation that we see. We still need to compound capital over the long term, and so we want to stay invested for our long-term needs in assets like equities. So again, let's be really thoughtful about syncing our capital with our calendar needs for that capital. Secondly, lock it in. We've actually been doing this across client portfolios. We've been adding a little bit of maturity to their fixed income where we can get greater than 5% yields in investment grade bonds and fixed income. To be able to get those types of yields for a longer period of time than just simply a year like cash or 6 months, we think this is a great opportunity, something we've not been able to do in the last 15 to 20 years. So we are absolutely taking advantage of the ability to lock in some of these attractive yields that we're seeing as the Federal Reserve still, as of this time, is communicating rate cuts, not rate hikes going forward. Energy infrastructure, hard assets, this really continues to dive into what we were just talking about with inflation. A couple of points on energy and why we think it's so important right now. For example, data centers, one is being built every 3 days across the world. These data centers are very energy consuming, and the BCG, McKinsey, and S&P all estimate the U.S. power demand to increase by 13 to 15% per year until through 2030. So massive needs for energy. It's going to be all hands on deck, traditional energy, clean energy, and so the need to continue to invest in that energy infrastructure we feel is a big opportunity. Lastly, always wanted to mention dollar cost averaging. I use 2013 and 2022 as examples here. 2013, the market kept setting all-time highs similar to what we're having now. In the year 2013, we never looked back. And so it was important to continue systematically putting money into the market, even when it was at all-time highs, as those highs were never tested again. Conversely, in 2022, we had dollar cost average programs where we were continuing to invest at lower and lower points as we had a lot of volatility in the market. So it's still a disciplined way to continue participating, getting to buy more shares each time you put money to work than you did the prior time. Either way, we think now is a great time to continue or start a dollar cost average program if you're looking to get invested into the market. It's a great way to stay disciplined and put money to work. Thank you so much for watching today. If you have any questions, please contact us, reach us. We look forward to hearing from you soon. Take care.